Hello, welcome to Sisters for Financial Independence. I'm Catherine Agupjan, and here at Sisters for Fi, we help you manage your money better so you can live a life of impact today and tomorrow. Today, we are going to talk about stock market investing and taxes. Before I move on, I just want to share a disclaimer that I am not a tax expert, and I would recommend for you to seek out and hire a professional if your tax situation is complex and requires professional help. This video is for educational purposes only, and I encourage you to hire a professional who understands your specific tax situation because they can help you avoid IRS penalties as well as save you money down the line. So today we are going to talk about stocks and how they are taxed. I am specifically mentioning stocks because you can put your money into other investments like real estate, collectibles, a business, and those will have different tax rules when you go to sell them. For this video, we will talk about investing in a brokerage account. This is our non-retirement, non-tax advantage account. When you put money into a brokerage account, you put in post-tax money that's already been taxed. As you build your portfolio, you'll buy investments like stocks. And depending on your time horizon, you may choose to keep the investments or sell them within a few days, a few weeks, or a few years. When you sell an investment for more than you paid for it, the result is called a capital gain. So for example, let's say you buy one share of Apple stock and that time it cost $100. And then you go to sell Apple stock and its value is now $150. The increase in value of $50 is your capital gain. And capital gains are realized when you sell the stock. Now, while it would be nice to pocket the $50, by selling an asset, you trigger a taxable event. And depending on how long you've held the stocks will decide the tax rate you'll pay on your capital gain. Capital gains are classified as either long-term or short-term capital gains and are taxed accordingly. Long-term capital gains must be held for 1 year and 1 day. Long-term capital gains are taxed using the following tax table. I am sharing both the rates for 2020 and 2021 since many of us haven't filed our taxes yet for 2020. You'll note that it's a very simple table with tax rates of 0, 15%, and 20%. Let's look at an example. This is for 2020 individual filers. And for 2020, individual filers won't pay any capital gains if their total taxable income is $40,000 or below. $40,000 can include income from work and income from sale of assets. However, you'll start paying 15% on capital gains if your income is $40,000 and $1 above. And then you'll have a different rate at 20% for those that have an income of $441,000 and $450,000. The other capital gain type is called short-term capital gains, and these are investments that are held with less than 1 year. Short-term capital gains are taxed just like your ordinary income, and depending on your tax bracket, it can mean up to 37%. Part of the reason short-term capital gains are taxed at a higher rate is to disincentivize speculative trading, which can result in market volatility. So if you've been buying low and selling high and keeping those assets less than 1 year, you'll get taxed accordingly. All right, let's walk through an example with actual numbers. For this example, I am using 2020 tax rates, and we are going through an example for an unmarried individual and then one with a married couple filing jointly. Let's start with the unmarried individual, and here is some stats about them. So annual income is $45,000. Their short-term capital gain is $5,000, so that means their total taxable income is $50,000. Now this is the tax rates for unmarried individuals for 2020. You'll notice that For the first 9,875, that income is taxed at 10%, and you'll see these values accordingly here. And remember that the US is on a progressive tax system, so the next bracket for this individual is at 12%, and this is the range for income. So that means that 30,249 of their income gets taxed at 12%, and here's the value here, and so forth. Now, for this particular example, we are going to look at the short-term capital gains taxes for this individual for the 5,000 in gains. And because this individual now makes over 40,126, a portion of their income will be taxed at 22%. And the short-term capital gain of 5,000 will be taxed at ordinary income using the marginal rate of 22%. So that means short-term capital gain of 5,000 gets taxed at 22%, resulting in this value at 1,100. All right, let's also go to an example for long-term capital gains. Same values, annual income 45,000. You have a long-term capital gain of 5,000, resulting in a taxable income of 50,000. You have the same values for the rates, and accordingly the taxes on the income. However, the change now is that because this is a long-term capital gain, we actually reference a different table for long-term capital gains. And as we saw before, the long-term capital gains rates are 0, 15%, and 20%. For this individual, unmarried and single, they're above $40,001. So their new tax rate for capital gains is 15%. So that means their 5,000 of capital gains is now taxed at 15%, resulting in $750. So note the difference there in capital gains. Same capital gains, but the taxes for short term is 1,100, and the taxes for long term is 750. And that's a significant savings for holding the asset for at least a year. Okay. Now, let's look at our married couple filing joint returns. Their stats are 170,000 is their annual income, short-term capital gain of 5,000, and their total taxable income is 175,000. And this is the tax rate for 2020 for married filing joint returns. You'll notice that now for the 10% rate, it's up to 19,750. So that first 19,750 of this married couple filing joint returns gets taxed at 10%, and here's your value of taxes on income. And then we move on to the next bracket. So 60,501 of their income gets taxed at 12%. Here's your value, moving to the progressive system. Now for this couple, their total taxable income is 175. So a portion of their income, which actually comes from capital gains, will now be taxed at 22%, and the rest gets taxed at 24% because where their income falls. This means that of the 5,000 in capital gains, a portion gets taxed at 22%, resulting in $231, and the rest gets taxed at 24%, resulting in $948. And that's a total of 1,179. And let's go down to the example of long-term capital gains. So this couple, same information, 170,000 in annual income plus long-term capital gain of 5,000 results in 175,000 in taxable income. And you have the same tax tables here for 2020 along with their taxes on income. And again, similar to the individual, we actually go to a different tax table for the long-term capital gains for this couple. So for married individuals filing jointly, the new tax brackets are different. So at 0%, income taxable gains are between 0 to 80,000, and then at 15%, it's 80,001 and $1 to $496,600. Now for this couple, because their total taxable income is 175, $100,000, it means that they fall in the 15% category. So that means that their long-term capital gain at $5,000 gets taxed at 15%, resulting in $750 of taxes. So the difference here, let's do a quick sum. $1,179 is taxed for short-term capital gain, and for long-term it's $750. So again, it pays to keep your money, keep your investments for at least that year and 1 day mark to go to the long-term capital gains rate. So what can you do to reduce your tax rate on capital gains? The first option is to hold on to your investments for at least a year and 1 day. This is using a buy and hold approach. The second is to use tax advantage accounts like 401k plans, 529 college savings accounts, and Roth IRAs. Some of these plans allow investments to grow tax-free or tax-deferred. That means you don't have to pay capital gains if you sell investments within these accounts. The Roth IRA and 529s in particular have big tax advantages, and qualified distributions from these are tax-free. So in other words, you don't pay taxes on investment earnings. With traditional IRAs and 401ks, you'll pay taxes when you take a distribution from the account in retirement. Another option you can try is to select and invest with a robo-advisor like Betterment, Wealthsimple, and others, as they can employ smart tax strategies to reduce your end-of-the-year tax burden. Remember with capital gains that the taxes don't get taken out, so it's up to you to set aside money to pay what you owe in taxes when you file. This is critical to remember. I hope that's been helpful as we learn more about capital gains and how they are taxed. If you found it helpful, please like the video, and if you want, subscribe. This is just for Fi, so you can learn more about how to manage your money better for now and the future. I will see you in the next video.